Hi there! In this video, we'll explain how capital allowances work, when sole traders buy a van, and what claims may be available in 2026-27.
A £1,887 tax bill versus an absolute eye-watering £10,094 tax bill. Just picture this for a second. You go out, you buy the exact same double cab pickup truck for your business, but because of a newly closed tax loophole, your tax liability skyrockets by over 5 times. I mean, it's wild, right? But this isn't some hypothetical scare tactic. It is the harsh new reality for so many UK business owners right now. For years, tradespeople have relied heavily on these incredibly versatile vehicles, but a massive, overlooked reclassification by HMRC means that what you confidently thought was a super tax-efficient commercial vehicle might now actually be classified as a heavily taxed company car. If you're planning to buy a work vehicle anytime soon, you simply cannot afford to overlook this shift. Hello and welcome to this comprehensive explainer. I'm your host, a highly experienced UK tax expert from My Tax Accountant, or MTA for short. We are a dedicated UK-based accounting firm, and our whole mission is providing clear, actionable tax guidance for self-employed individuals and small businesses just like yours. Look, whether you're a builder, a plumber, an electrician, the vehicle you drive is literally the lifeblood of your work. You can't do your job without it. But the tax landscape for these vehicles has just fundamentally shifted beneath our feet. So today, we're breaking down everything you need to know about capital allowances for sole traders buying a van in the 2026-27 tax year. My absolute goal today is to make sure you navigate these new rules safely, efficiently, and most importantly, without falling into an incredibly expensive tax trap. Okay, let's dive into this, shall we? Here's the agenda we'll be covering today. We're going to start right off with the 2026 van tax shock and exactly what the end of the pickup loophole looks like. Then we'll ground this in reality by looking at a case study of a UK electrician to really unpack those new tax implications. After that, we'll walk through the essential steps you need for compliance, take a hard look at the actual pound sterling financial outcome, and finally, wrap up with how you can get proper professional advice on all of this. Section 1. The 2026 van tax shock. The end of the pickup loophole. So historically, things were pretty straightforward. If your double cab pickup could carry a payload of 1 ton or more, HMRC just smiled, nodded, and treated it as a commercial van. This was brilliant because it unlocked fantastic tax reliefs, most notably the 100% annual investment allowance, or AIA as we call it. But HMRC has completely changed its mind here. Driven by recent judicial precedents, specifically the Payne versus HMRC case, the courts essentially decided that because these vehicles have second-row seating and are, let's be honest, perfectly suited for taking the kids to school or going on a weekend trip, they are actually multi-purpose. Therefore, from April 2025 onwards, for direct tax purposes, they are reclassified as passenger cars, meaning you completely lose that 100% annual investment allowance. It's a massive game changer, and it's catching thousands of hardworking tradespeople totally off guard. Section 2. Case Study, the Electrician. Let's look at a real-world scenario. I want you to meet Tom. Like a lot of self-employed UK electricians, Tom's trusty old van has finally given up the ghost. It's done. He's gone out and sourced a brand new work vehicle for £28,000, and he's ready to pull the trigger in September 2026. Now, because this purchase falls squarely into the 2026-27 tax year, Tom is unknowingly standing on a massive financial landmine. You see, depending on the specific make and model he chooses, and exactly how his accountant records it, his impending tax bill is going to vary wildly. For a sole trader like Tom, a £28,000 cash outlay is a huge chunk of money, and getting the tax relief wrong on this could severely damage his business's cash flow for literally years to come. Section 3. New tax implications explained. Navigating the 2026 allowances. Now, what's really interesting about this slide is the stark contrast in the tax routes available to you. If Tom buys a standard panel van or a single cab pickup with over a 1-ton payload, HMRC still generously treats them as commercial plant and machinery. Fantastic. He can claim the 100% annual investment allowance and wipe that full £28,000 straight off his taxable profits immediately. But if he chooses that double cab pickup, it is now classed as a car, and because it's heavy and likely emits high CO2, it gets dumped into what HMRC calls the special rate pool. In plain English, instead of deducting 100% in year 1, Tom can only deduct a miserable 6% per year. 6%! It will literally take him decades to write off the cost of that vehicle, significantly inflating his tax bill right now when he needs the cash the most.
To make matters even tighter, the government has permanently slowed down the rate of standard tax relief across the board. If you're relying on the main pool writing down allowance, maybe because your annual investment allowance is already used up on other equipment or you're dealing with older assets, well, that allowance is dropping from 18% down to 14% starting April 2026. Now, I know that might just sound like a small percentage shift on paper, but for cash-strapped small business owners, it means your money is tied up for so much longer before you see the tax benefit. This is exactly why claiming the 100% AIA or the newly introduced 40% first-year allowance for new main rate assets is absolutely vital for maintaining a healthy cash flow.
Time for a quick insight. Did you know? Look, electric vans are still a really fantastic, eco-friendly choice for your business. They fully qualify for the 100% annual investment allowance, and they remain exempt from the van benefit charge if you happen to have employees using them. But did you know that the free ride on road tax is actually over? Yeah, as of April 2025, zero-emission vans lose their vehicle excise duty exemption entirely. So for the 2026-27 tax year, running an electric van is going to cost you around £350 a year in road tax because they now pay the standard light goods vehicle rate. It's a subtle change for sure, but definitely one you have to factor into your monthly running costs.
Right. Now we have to talk about how Tom actually records this massive purchase on his tax return. For sole traders in the UK, the cash basis of accounting is now the statutory default. Under cash basis, accounting is treated quite a bit like your own personal bank account. Money in is income, money out is an expense. Simple, right? You bypass the complex capital allowance pools entirely and simply deduct the full cost of the commercial van as an immediate business expense the second the cash leaves your account. The alternative is the traditional accruals basis. Under accruals, you record income and expenses when they're billed, not paid, and you must formally claim capital allowances like the AIA on your tax return. Now, choosing between these two is absolutely critical. Let me explain why.
Professional tip, listen closely to this one from our experts at MTA. While the cash basis sounds brilliantly simple, it completely lacks flexibility. Under the cash basis, you cannot restrict your capital expenditure deduction. So if Tom has a low profit year, expensing a £28,000 van all in one go might actually wipe out his profits entirely, pushing his income below the £12,571 personal allowance. That effectively weights his tax-free threshold. He loses that allowance forever, you can't get it back. So if your profits are low, you should actively elect to opt out of the cash basis on your self-assessment return. Use the accruals basis instead and strategically tailor your capital allowances claim to preserve your personal allowance. It's a lifesaver.
Section 4, Essential Steps for Compliance. How to stay on HMRC's good side.
Okay, here are the 3 critical steps Tom and frankly all of you must take. Step 1. Rigidly review the vehicle's payload and seating before buying it. You have to avoid multi-row passenger utility hybrids if you want that 100% deduction. If you desperately need the utility, look for a converted 2-seat variant with a fixed bulkhead. Step 2. Actively review and elect whether the cash or accruals basis serves your specific tax profile best for that year. Don't just settle for the default. And step 3, implement digital mileage logs immediately. Listen, from April 2026, making tax digital for income tax, or MTDIT, becomes completely mandatory for sole traders earning over £50,000. HMRC will absolutely no longer accept a dusty, scribbled notebook of estimated miles kept in your glove box. You will need precise, app-based digital records to prove every single business mile.
Section 5, the financial outcome. Let's talk actual pound sterling savings.
And this brilliantly illustrates the sheer scale of the tax trap we've been talking about. Look at this. If Tom buys a proper standard panel van, he deducts the full £28,000 against his trading profits in year 1. Fantastic. But if he falls into the trap and buys a reclassified double cab pickup with high emissions, he is heavily restricted to that 6% special rate allowance. That is a tax deduction of just £1,680 in the first year. Just think about that for a second. He has spent £28,000 in cold hard cash but can only offset a tiny, tiny fraction of it against his current tax bill. The negative impact on a sole trader's cash flow is absolutely staggering, and it perfectly highlights exactly why this loophole closure is so devastating if you're not prepared.
But there is one final vital caveat to Tom's claim, and it's represented by this figure right here, £19,600. You see, as a sole trader, you must apportion your expenses for private use. If Tom uses his new £28,000 van, 70% for business and 30% for personal trips, like the weekend grocery run or taking the kids to football practice, he cannot claim the full amount. He can only claim 70% of the AIA. That means his actual legal tax deduction is exactly £19,600. The remaining £8,400 is disallowed and permanently lost for tax purposes. This is exactly why step 3 on our compliance checklist, keeping those immaculate digital mileage logs, is completely non-negotiable. If HMRC investigates, you must be able to confidently prove that 70% business split with hard data.
Section 6. Professional advice and next steps. Partnering with MTA. So the crucial point is this. Let's do a quick recap. The landscape has fundamentally changed. The 2025 and 2026 loophole closures mean double cab pickups are now heavily taxed as passenger cars. For your older assets, the main pool writing down allowance has been sluggishly reduced to 14%, which just ties up more of your cash. Furthermore, the cash basis is now your statutory accounting default, meaning you have to actively opt out if you want to protect your personal tax-free allowances. Ultimately, as we saw with our friend Tom, proper planning saves thousands of pounds in year 1 alone. Being proactive rather than reactive is absolutely the key to surviving these changes. The distinction between a tax-friendly commercial vehicle and a heavily taxed car is now razor thin. The accounting method you use to record your purchase can drastically alter your final tax bill, and literally a single mistake can lock up your hard-earned cash flow for years. As a business owner, you already have enough plates spinning, don't you? You shouldn't have to memorize hundreds of pages of constantly changing HMRC tax legislation on top of it all. Before we conclude today, please do note the following disclaimer. This explainer is for general informational purposes only and does not constitute formal tax, legal, or financial advice. Tax laws are inherently complex, and as we've seen, they're always subject to change. We highly recommend that you seek professional guidance tailored specifically to your personal and business circumstances before making any major financial decisions. If you want to ensure your business is as tax efficient as legally possible, we are here to help. Contact the expert team at My Tax Accountant for bespoke advice. You can call us directly on 0208 570 8531. You can drop us an email at info@mytaxaccountant.co.uk or just visit our website at www.mytaxaccountant.co.uk. And hey, if you found this explainer valuable today, please hit subscribe on our MTA YouTube channel so you never miss out on these crucial tax updates. Thank you so much for joining me today. I'm going to leave you with this one final thought. Are you absolutely certain your next big vehicle purchase won't trigger a devastating tax trap? Don't leave your hard-earned money to chance. Happy planning!